You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. You know, if you've been watching the headlines lately, it's clear the global landscape is just so interconnected. Economic shifts, commodity prices, trade spats, geopolitical stuff. It's not just separate events anymore, is it? They're all tangled up, influencing each other constantly. Yeah, it's a real web. And honestly, keeping up feels like a full-time job sometimes. So our mission today, let's try and cut through some of that noise. We've gone through a pile of sources, briefings, articles, research, and we're going to pull out the really important bits. Think of it as your shortcut to getting up to speed, your essential update on what's really moving the needle in global markets and news right now. Today, we'll zero in on some pretty interesting currency movements. We'll dive into commodities. Oil and gold are doing some fascinating things. And there's the whole world of trade talks, high-stakes stuff there. And of course, we can't ignore the geopolitical hot spots shaping things. Ready to unpack it. All right, first up, currencies. The US dollar, it's trying to claw back some ground after being under pressure, you know. The DXY, that's the dollar index, it's trading near the top of its recent range. And everyone's got their eyes peeled for that University of Michigan sentiment data coming out today.
Yeah, that release is potentially quite pivotal for the dollar's next move. And it's worth understanding why that specific data point gets so much attention.
Right. Why the UMIC data?
Well, it's more than just a number. It taps into consumer confidence, crucially their inflation expectations, and even what they're planning to buy. For markets, it's kind of a forward-looking indicator. It hints at future economic activity.
And what the Fed might do next, presumably.
Exactly. It signals whether the Federal Reserve might need to tweak policy, keep rates higher for longer, or maybe delay cuts. So a strong number could boost the dollar, suggesting a more, let's say, hawkish Fed. A weak one could do the opposite. And the ripple effects on where capital flows globally could be pretty substantial.
Okay, so beyond just the dollar moving up or down, if that data does signal something significant, what's maybe an overlooked consequence? Like, does it hit risk assets more broadly?
Oh, absolutely. Beyond the immediate currency reaction, yeah. A strong report might suggest consumers are still spending, pushing up inflation expectations. And that could force investors to reprice stocks and bonds, adjusting their forecasts and discount rates. It's a subtle signal, but it can shift entire asset allocations, not just FX pairs.
That makes a lot of sense. Okay, let's hop over to Europe. The euro seems to be holding its ground, for now at least. Your USD is pretty steady after we heard that quite hawkish tone from the European Central Bank on Thursday. Our sources are saying an October rate cut looks, well, unlikely. It seems policymakers might wait until December, when they have fresh economic projections, to talk about easing again.
Yeah, holding steady is a good way to put it.
Yeah.
But is it genuine confidence or just buying time?
What's your take?
I think it's a bit of both, really. The hawkish talk projects confidence, certainly buys them time. But December is crucial. Those new projections will give a much clearer view of the Eurozone's health inflation, jobs, growth. Until then, the stability is mostly because the market knows there's no immediate action coming. It's not necessarily a sign the economy's booming. Any bad news before December could easily shake that up.
Okay. Meanwhile, across the channel, the pound looks a bit softer, doesn't it?
Yeah, GBP USD dipped a bit.
That followed the UK GDP data. It came in right on target, matched expectations.
Which sounds fine, but...
But in line just wasn't enough, apparently. It didn't offer any real upward push, so markets are just sticking with their current Bank of England rate expectations. No pressure for imminent changes.
Exactly. In line basically means no new catalyst. Nothing to push the BOE towards tightening or aggressive easing right now.
So the BOE is just reacting, not leading.
Pretty much. The market sees them as reactive for now. Resilience might pop up if, say, wage growth surprises or inflation ticks up unexpectedly. But without that, the current path seems baked in. The soft GDP just confirms growth is sluggish, which limits how hawkish the BOE can really be.
Now, here's where it gets really interesting, I think. The Japanese yen, it's really underperforming, sitting at the bottom of the G10 FX board.
Yeah, quite noticeably.
And for listeners, the G10, those are the world's 10 most traded currencies. This weakness in the yen seems directly linked to political uncertainty, right? Prime Minister Ishiba resigned.
Correct.
And the risk, sources suggest, is that these leadership shuffles could delay any tightening moves from the Bank of Japan. It's amazing how fast politics hits the currency markets, isn't it?
It really is. A classic example of political risk turning immediately into economic uncertainty. The BoJ has been walking such a fine line, trying to edge away from that ultra-loose policy very, very carefully.
Right.
A leadership vacuum, or even just a new administration with different priorities, could easily delay crucial decisions, like rate hikes.
And the market reaction.
Well, delay opens up the carry trade, selling the low-yield yen to buy currencies with higher yields. That pushes the yen down. The market's basically pricing in more political friction, slowing the BoJ down.
Gotcha. Okay, just to round off the currency picture. The Aussie and Kiwi dollars, the Antipodeans, they're also a bit weaker against the US dollar. Seems to be tracking a general dip in risk appetite during European trading hours.
Yeah, broader risk-off move.
And over in China, the PBoC, the central bank, set the USD CNY fix slightly stronger than expected, 7.1019. This overall dip in risk sentiment, is it widespread? What's driving it today?
It does feel pretty broad-based. It's likely a mix of things. Ongoing uncertainty in Europe, some of those trade tensions we're about to get into, and just general caution ahead of key U.S. data, like that Michigan report.
Makes sense.
When worries about global growth or geopolitics flare up, currencies like the Aussie and Kiwi, which are tied to trade and commodities, they tend to soften up as investors look for safer harbors.
Okay, so currency showing lots of different pressures. Let's shift to commodities now, because we're seeing some equally dramatic moves there.
Definitely.
Crude oil, for instance, quite a surprising rebound today. It started soft, but now both WTI and Brent are trading at session highs.
Yeah, interesting turnaround.
And reports are linking this recovery to news that EU officials think it's unlikely the G7 will actually slap those massive 100% tariffs on China and India. They specifically mention India's importance as a trading partner. How does that work exactly? How does just the unlikelihood of tariffs suddenly boost oil prices?
It's mostly about demand expectations and supply chain stability. Look, tariffs, especially huge ones like 100%, they would absolutely hammer global trade and economic activity, particularly for big energy users like China and India.
Okay.
If the G7 did impose them, it signals a major global slowdown, hitting oil demand forecasts hard. So the news that they're unlikely, that lets the market breathe a sigh of relief.
So it implies demand might hold up better than feared.
Exactly, or at least no immediate downward revision to demand. And that supports oil prices. It's a direct link. Trade friction fears easing translates to better growth outlook, which means more oil needed.
Fascinating interplay. And talking about interesting moves, precious metals are absolutely shining. They're rallying hard despite that dollar strength we were just talking about.
Yeah, that's the really striking part.
Silver actually broke above USD 42 an ounce. Incredible. And spot gold is holding strong between $3,622 and $3,649 an ounce. That's near the all-time highs from earlier this week.
Remarkable performance.
That gold and silver rally against a strong dollar.
Yeah.
It really makes you wonder what deeper anxieties are bubbling under the surface, doesn't it? What fundamental driver is overriding that usual inverse link?
It's a critical divergence, you're right. Normally, strong dollar equals weaker gold because it's more expensive in other currencies.
Right.
But when they both rally, it often points to something deeper than just currency moves. We're likely seeing a flight to safety.
Driven by what? Geopolitics? Inflation?
Probably both. Geopolitical tensions are high, Middle East, Ukraine, plus lingering inflation concerns. Investors are grabbing gold as a hedge against that global instability and as a store of value when things feel uncertain.
And central banks.
Central bank buying is still a huge factor too, often under the radar, but significant. They're diversifying away from traditional reserves.
That definitely clarifies the forces at work. Okay, shifting slightly, base metals are also firm. They got a boost from supply worries after news that copper output in Peru fell 2% in July.
Supply concerns supporting prices there, yeah.
And check out this forecast. Commerzbank just upped its gold price target. They now see USD 3,800 an ounce by the end of 2026, and higher forecasts for silver and platinum, too.
$3,800. That's a big call.
Given how volatile things are day to day, how seriously should we take these long-term forecasts? What assumptions are usually baked into those numbers?
Well, long-term forecasts like that are useful for framing expectations, but you have to remember they're built on a whole stack of assumptions.
Like what?
Assumptions about inflation, interest rates, economic growth, geopolitical stability. none of which are guaranteed, right?
Sure.
A $300 to $800 target by 2026 probably assumes we see continued geopolitical risk, ongoing currency debasement through inflation, and maybe persistent central bank buying. If any of those core assumptions change significantly, the forecast could quickly become invalid. Think of them as directional guides, not crystal balls.
Good perspective. Okay, one more on energy. We heard the U.S. Energy Secretary make a pretty pointed remark. She suggested a faster EU phase-out of Russian energy could help shorten the Ukraine war.
A direct push there.
Yeah, encouraging Europe to move quicker on cutting Russian oil and gas. It's a powerful strategic statement, but could a faster phase-out actually backfire? Could it destabilize energy markets more, maybe hurting the EU itself, especially with winter coming?
That's the tightrope they're walking, absolutely. It's a very real concern. The goal is obviously to hit Russia's war funding, but move too fast without enough alternative supply, like LNG or enough storage, you risk spiking energy prices for European homes and businesses.
Which could cause economic pain, maybe even unrest.
Exactly. It risks contraction, social issues. So the timing, the alternative sources, the infrastructure, it all has to line up. It's balancing that geopolitical goal with economic reality. The Secretary's statement is a clear nudge, but actually doing it, complex and risky.
Right. These geopolitical threads are clearly pulling at markets, energy policy, and they feed straight into global trade, too. So what's the latest there in the world of international negotiations?
Well, U.S. Treasury Secretary Bessent has been doing the rounds in Europe this week. A busy trip.
Yeah, looked packed. Meetings with Chinese Vice Premier He in Madrid talking U.S.-China economic and security issues. Everything from TikTok to money laundering cooperation.
Key meeting, that one.
Then meetings with Spanish officials, and later this week joining President Trump in the U.K. for a state visit with King Charles. What's the common theme here? Which of these meetings is most critical for the global economy, do you think?
The common thread is really about managing and shaping global relationships in this increasingly multipolar world. Each meeting tackles a different piece of the U.S. strategic puzzle. The UK visit has its symbolic weight, sure. But I'd argue that Madrid meeting with China's vice premier, he is probably the most critical right now.
Why that one specifically?
Because it's a direct attempt to manage the massive friction, economic and security, between the world's two biggest economies. They're trying to find ways to cooperate while still drawing lines on sensitive stuff like tech and finance.
And the outcome matters globally.
Hugely. What happens in those talks directly impacts global supply chains, tech development, even regional stability. Really far-reaching implications.
Okay. Elsewhere on the trade front, China's Commerce Ministry wasn't happy about Mexico's planned tariffs. They criticized them publicly.
Yeah, warned it would hurt business confidence.
And they pledged to take necessary measures in response. That sounds like potential escalation. How big is the risk this spirals into a wider trade fight? And what could that do to supply chains, especially in North America?
The risk of escalation is definitely there. Tariffs often provoke retaliation, right?
Readily.
No, so if Mexico goes ahead and China hits back, it creates huge uncertainty for any business operating in or through those countries. It could speed up that trend we're already seeing, friendshoring or nearshoring companies moving supply chains out of areas seen as risky.
So Mexico could lose out.
Potentially. It could mean companies rethink Mexico as a manufacturing base, maybe shifting investment elsewhere or even back to the U.S. It directly threatens those established trade routes.
On a slightly brighter note, Taiwan reported some progress in its trade talks with the U.S. They're aiming for more balanced reciprocal terms.
Progress is good news there.
But what are the real challenges for Taiwan in getting genuinely balanced trade with a giant partner like the U.S.?
Well, Taiwan's big leverage is its semiconductor industry, obviously. It's vital globally. The opportunity is to cement that relationship, secure U.S. market access for its tech, maybe get good terms on imports or investment. The sheer size difference. The U.S. economy is massive compared to Taiwan's. So achieving true reciprocity often means tough negotiations over market access in areas where Taiwan might be less competitive. Plus, there are always the political sensitivities surrounding any deal involving Taiwan. It's a delicate balancing act.
Leveraging strategic importance while managing economic realities.
Yeah.
Okay. Lastly, U.S.-India relations. The U.S. ambassador designate to India said bilateral issues are getting resolved.
Positive signals there.
But Washington also reiterated its expectation that India needs to stop buying Russian oil. India is clearly trying to balance things here. What are the long-term consequences if this U.S. pressure keeps up? For energy markets, for India's own foreign policy?
India is definitely in a tricky spot. balancing its need for affordable energy against its strategic partnerships. If U.S. pressure really ramps up and India cuts back significantly on Russian oil, they'd have to find other suppliers, maybe more from the Middle East, maybe even the U.S. That could nudge global oil prices.
And for India's foreign policy?
It really tests their commitment to strategic autonomy. Their ability to chart their own course. It shows how economic tools are being used to push for geopolitical alignment. It forces nations into difficult choices that can reshape trade and alliances for years to come.
That's a really critical point about how tangled these relationships are. Okay, let's pivot finally to the geopolitical front itself. Tensions still incredibly high, especially in the Middle East.
Very much so.
Israel's UN envoy gave a stark warning. Israel will keep acting against terror leaders wherever they hide. Then Qatar's prime minister condemned an Israeli strike in Doha, calling it a violation of sovereignty, an attempt to derail peace talks, and warned Qatar wouldn't tolerate more infringements.
Strong words from both sides.
Now, just to be clear, we're reporting these statements as they were made, impartially. But what do these declarations signal about the chances for de-escalation right now?
Well, they really highlight how volatile and entrenched things are. Qatar condemning a strike on its own soil is extremely serious diplomatically. It hints at the conflict widening and directly threatens mediation efforts.
And Israel's statement
Reaffirms their security stance, their perceived need to act, taken together. Unfortunately, it signals a higher risk of more incidents and makes immediate de-escalation look very challenging. Peace talks seem even more fragile now.
Absolutely. Switching to the Russia-Ukraine conflict context, Japan announced more sanctions, asset freezes, a lower price cap on Russian crude.
Tightening the screws.
They also restricted exports to entities in China, Turkey, and the UAE, presumably trying to close loopholes.
Secondary sanctions kicking in there.
And we also have G7 finance ministers meeting to talk about new U.S. ideas for even higher tariffs on Russian oil exports.
More economic pressure being discussed.
And as we mentioned with commodities, EU officials still seem skeptical about those huge 100% tariffs on China and India, worried about the blowback on trade.
Yeah, that skepticism remains.
And to cap it off, NATO leadership has a press conference later today. Could be further updates on the alliance's stance. So putting all this together, Japan's moves, G7 talks, EU caution, NATO meeting, what's the overall strategic goal? And are these escalating economic measures actually working?
The broad strategy is, well, it's several things. Degrade Russia's war funding, limit its global influence, and just signal international condemnation. Japan's actions, the G7 talks, they show a coordinated effort to tighten that economic noose.
But the EU hesitation.
And that highlights the real-world limits, the potential unintended consequences. Full effectiveness is hard when global economic interests don't perfectly align, and major players, well, they keep dealing with Russia to some extent.
So are the sanctions hurting Russia?
Oh, they're definitely inflicting pain, yes. But the ultimate strategic impact, that's still playing out. It really depends on continued international solidarity or the lack of it. Today's NATO press conference will likely try to project unity, even while navigating these tricky economic realities.
That's a really powerful and nuanced thought to consider as we wrap up today's deep dive. We've certainly covered a lot of ground. The dollar's push, that really fascinating gold rally happening despite the dollar, the complex dance around global trade, and those critical geopolitical tensions that just don't seem to fade. It's a very dynamic picture.
Absolutely. Constant interplay.
So as you go about your day, probably worth keeping an eye on key things like that University of Michigan data could be quite telling. Any more headlines from trade talks, and obviously how these geopolitical situations evolve, these seemingly small daily shifts, they really do have the potential to keep influencing markets in pretty big ways.
Indeed. And maybe something to ponder. What does this confluence tell us? A recovering dollar, gold rallying anyway, shifting trade alliances. What does it suggest about the underlying stability or maybe the emergence of a new order in the global economic and political landscape? And how might all these small daily shifts we talked about actually compound into really significant changes by the time we get to the end of the year?
Definitely a lot to think about there. Thank you for joining us for this deep dive into the current global landscape. We'll be back soon with more insights.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.